This is Talking Capital Markets, where ideas drive the markets. We move past the headlines and into the heart of the deal, breaking down IPOs, M&A, governance, and the strategies driving real growth in today's capital landscape. No noise, no hype, just conviction, execution, capital in motion. If you're building companies, raising capital, advising boards, or deploying investment, you're not just listening, you're in the room. And now, here are your hosts, Mike Blankenship and Brian Jue.
Welcome to Talking Capital Markets with Mike and Brian, your go-to source for insights at the intersection of law, finance, and business. I'm Brian Jue, and as always, my co-host, Mike Blankenship.
Thanks, Brian. Great to be with you today. Doing all right.
All right. So, we've talked about going public a lot, IPOs, SPACs, and sometimes people get confused and they think that, one is the same. There's only one way. But the reality is there are multiple ways to go public. There's more than one way to become a publicly traded company. And so we've talked about the traditional route, an IPO, where a private company will file an S1 and go down that road and through that process. And then we've talked about the SPAC, which is very popular right now. And you have just done some incredible things in that space. And we've talked about direct listings. Today, though, let's talk about something that it's got a little bit newer name that people are using these days, but goes way back in time. The RTO, the reverse takeover, or for old school guys, the reverse merger.
Yeah, you've listed the kind of four ways to go public. I think, we've seen an iteration of a history of all of them. Obviously traditional IPOs is the oldest way of doing it, and you would, dating back almost over 100 years ago, but you would take a company public, list those securities from that company that would trade and have the inherent value based on, financials of the company, what people value the future of that company. And then you have your SPACs, which evolved in the 1990s and then have, changed many iterations since. We've seen ways of doing that, but essentially it's a blank check company with a pool of money that mergers with a target or private company. And then that private company either becomes the survivor or the SPAC becomes the survivor, depending on the tax structure. And then that private company is, going forward as the public one listed on Nasdaq or NYSE. And then you have direct listings, which is relatively new. And that was a way for companies with a lot of shareholders. So you talk about ones that may have done a Reg CF or Reg crowdfunding, raised a little bit of money, had a ton of shareholders from that. And to create some liquidity, we'll go out and maybe list on an exchange and then do some potential other kind of secondary offering or do another kind of pipe offering to get some cash in the door. And then finally, you mentioned the reverse takeover. That's simply something we saw a lot in the 2000, to 2009 timeframe, and we're starting to see a lot of those too. That's essentially a private company or an asset-based company, either way, merging into a public company vehicle, and then it becomes the public company, and it's similar to almost the SPAC type process, but can be faster. The problem with RTOs, or again reverse takeovers, is that you've got a company that you really have to diligence to make sure there's nothing there. So if you have a life science company that you're going to do an RTO and you're an energy type company, well, FDA may have some approval requirements on the change of control for that if they're FDA type products the life science company had applied for or done. So that's some diligence factors you have to keep in mind. Or there's ongoing litigation that may not be disclosed, but some of it can be nuisance-based litigation. So just don't know until you diligence. So that's what RTO, where SPACs are cleaner vehicles because they've IPO'd, and they have to find a deal within 2 years generally. And that means there's not much hair on them because they're not going to get a lawsuit because management company looking for deals. There's nothing there. There's no breach of contract there. There's nothing happening. They're just out there looking for deals. If they don't succeed, then they liquidate the trust and the money goes back to shareholders. If they succeed, people have the option of redeeming out. And so therefore there's like real no damages because they're getting their money back. Maybe some perspective type stuff, but generally they can find that. So those are the 4 ways, Brian. I think we're starting to see a resurgence on the IPO front, which was a lull in the last 5 years. And then on the SPAC front, you see, a couple hundred out there looking, and which means hopefully we'll get some, pretty good deals out there. We've seen a few, as we mentioned before. We've had a couple with 0 redemptions, which means the investors liked it. So
I think let's dig in there a little bit about the history of the RTO and reverse mergers, and that there's been a lot of really big companies that's the route that they became publicly traded. Warren Buffett, we all love him, and he's looked at it with reverence for good reason. But his foundation, how he built everything, is he did reverse mergers, and eventually Berkshire Hathaway, that was a reverse merger. You look down from there, you've seen Heinz Kraft, the New York Stock Exchange, T-Mobile, and Metro PCS, Burger King, Nintendo, DraftKings, all kinds of biotech deals, on and on and on. There have been some real successful transactions that were RTOs. And from what we're seeing, there's going to be more of those as well. There are going to be a Nasdaq, New York Stock Exchange level companies that went public, that things didn't work out. They're still there. They're still a public entity, and there's an opportunity there. Now, those transactions work a little bit differently. Mike, can you maybe dig in and give us a little perspective there on the differences with both the New York Stock Exchange and NASDAQ and the RTO process?
Yeah, look, they both are going to look at it from depending on how many shares are issued. So they both have the 20% rule. So if you're doing that, then you may have to get a shareholder approval for that, and likely will, just given the requirements there. I do think that Nasdaq and NYSE are going to look at the shareholders and the owners of the previous. They want to know who the manager will be kind of going forward, and so they're going to want to know a lot more about kind of the go forward pubco. And I think those are the kind of critical things that you have to keep in mind, especially now with Nasdaq and its IM 5101-3, where because you're going to have to get approval likely for maybe a new listing, and so they can turn that down. So you really need to make sure you have the right team, and maybe ones that have some public company experience, because they are going to look down that. That's what they do on all these transactions. I think they're going to continue to do the same things, because especially change of control, which is going to require shareholder approval.
And that's a great point, and something that I think no matter which route is chosen by the private company looking to go public, is that you really need, and we've talked a lot about this, you really need a team with experience. And it's, your advisors, your consultants, the people within the management team in the C-suite. Without that comprehensive experience of operating and managing a publicly traded company, it can often be a recipe for disaster, right?
Yeah, I mean, investors are relying on your experience and relying on you to help grow their investments. Or maybe they believe in the company, but if you don't have that requisite, experience, I think some of the exchanges will doubt it, so will investors, and it's just harmful for the stock.
Absolutely. And I think too, another facet that we've often talked about is preparation. To this day, I still get, all kinds of inquiries about, hey, I want to go public, can you take us public? We have this, and this. But if they're not ready, they're not ready. There is no shortcut for having your audits done, PCAOB audits, and then that's something that I've run into with so many private companies over the years is the confusion there. They think if they have a financials audited by their CPA or a bank level audit, that's good enough, and that is not the case at all, not even close. Right, and there's so many other facets there. Same thing with legal counsel. They say, oh well, no, well we have an attorney that did this and did this. Sure, a lot of the forms are you can just fill them out and find them online and do your thing. But if you don't know the ins and outs, you're going to end up in a continuing comment period that just goes on and on and on. And you need experienced people.
Yeah, I mean, it's all about that, and I think that's what's going to help you propel your growth. And this story that we talked about before, you need people to be able to do that and recognize it, and then recognize the requirements. Right? No one's out there just giving selective disclosure, but they're well trained to not do that. And so those are important things, and you need a CFO and an accounting group that understands financials and updates on financials and all the things that change. I mean, this is an area where we do see changes. They may be slower than some, but they do evolve. Disclosure requirements evolve depending on who's in charge and what they believe. And so you got to stay attuned to that. So you need an experienced team that can do that.
And I think too, beyond the experienced team, is a team that collectively knows how to work together. Because you might have an experienced group that, or, for example, you have an experienced auditing team, you have an experienced CFO, you have an experienced SEC attorney. But if they are not communicating together and communicating well, they're not going to get anywhere.
Completely agree. I mean, it's just not going to, it's going to be an impasse, and it'll be very difficult. So you have to be aligned. It's a team effort.
So whichever route you go, whether it's the traditional IPO, the SPAC, a direct listing, or RTO, and they each have their different attributes and there's different reasons why. One thing is for sure, is that if you prepare, you have the right story, you have the right team, you give yourself optionality, you give yourself the ability, you're not just yourself, but the company and your shareholders, of course, you give the possibility of having the utmost success with optionality. So that's Talking Capital Markets for today. I'm Brian Jue. Thank you, Mike, as always. Join us next time for another episode.